All right. Hey, trust you are doing well. And hopefully it is, God willing, you've had a great week this week. Just wrapping up things here on a Friday. Wanted to share with you some of the things that we've been thinking about, talking about. We've seen the continued strength of the economy. There's the talk of the soft landing. There's a couple of things that, we've spoken about before, but we see credit card delinquencies have begun to rise. There is a reality that the majority of people who had received the stimulus monies, that money has been spent. We see that a good number of Americans, are effectuating spending with increasing credit card balances. So you've got balances rising, and then you also have delinquency on those balances increasing. So that's something definitely to watch. Inflation had moderated, but again, as I shared before, it didn't moderate to the expectation that was had by the Fed or the marketplace. And so that, kind of spooked the bond market and also impacted the stock market, caused rates on the 10-year to go from, 385 to 425. It also caused that forward-looking curve to rise as well because they were trying to price in, as we shared before, a rate cuts happening potentially even by March. And, I think more realistically, it's, summertime, June or July. So, that being said, there's what I wanted to talk about as well is, people, what's the expectation? There's some people, and I shared this before, some people are peddling kind of a complete doom and gloom, setting up a straw man, talking about, hey, this is what's happening with apartments, so you should invest over here with me, kind of a straw man fallacy approach. And I've shared with you that there are, apartments that are going to be dealing with difficult loan maturities and properties that have to sell based on those realities or, the poor underwriting that was done. We've covered all those bases. But one of the things that I would say that is there is a strong continued demand for housing. There's a strong structural need for quality rental housing. And then a real key variable that people have not spoken about is there is over $9 trillion with a T, trillion dollars in money market funds, cash, and CDs. That figure has actually grown this year already even further. And, so that's something that is a tremendous amount of capital, tremendous amount of money, and that money has to go somewhere. It is not going to stay in cash in a perpetual scenario. It is going to find its way into primarily three areas: the stock market, the bond market, and real estate or alternatives. And so, that's where, you have to take that into account. And with that being said, certain people I've heard, we're looking for 30 and 40% discounts. Maybe in some office type stuff that's just totally being devastated because of the change of the structural reality of, people working in hybrid and things of that nature. But, as I shared before with multifamily, we've seen about 10 to 12% off of the high price of, 2021. And then, even properties that are going under distress, probably maybe it's another 10 to 15%, and that equivalates to the equity, meaning that the property sold for the debt. So that being said, we're expecting some great opportunity up ahead, but I also want to be realistic that it's not like a give away the farm kind of thing. And there's people saying, oh my God, this is going to be a once in a lifetime buying opportunity. It's like, you can always find good quality deals if you dig deep enough, work hard enough, and search in the right areas. Now, that being said, we expect there'll be some good opportunities, no doubt. And so I want to just encourage you and remind you of that. But also I would say for your own holdings, I've talked to people that own other real estate beyond just apartments. And, you've got to look at these things in terms of the overall macro investing and recognize that though, yes, we have some economic slowdown. And now that being said, there could be, some type of outside event that we don't have right now on the table, and it could cause deterioration in the economy quickly. And if that happens, definitely there's going to be a retracement of interest rates in a more rapid fashion, but also a economic impact on the overall economy that could be negative, and that could further push more properties or deals that need to be sold. So there's still an uncertainty of time frame, but what is certain is $9+ trillion sitting in cash is going to be moving into investment category space over the next 18 months. So the remainder of 24, and what will happen is you see as interest rates start to moderate, so somebody's earning 5.25 right now in a money market account, then it drops to 5, 4.75, 4.5. They're recognizing, hey, I'm losing ground here. I need to begin to do something. That money's going to be moving. You watching this video, you are probably one of those people right now that have money in money markets that adds up into the trillions of dollars. So again, that's also going to help to bolster the various markets. And again, there's a good number of people that will rotate in funds as well, meaning fund management will rotate into the bond market. And as that money rotates into the bond market, that will drive price up and yield down. And we'll see that further impacting the 10-year treasury. So again, just definitely things to be observing and watching at this time frame. And I appreciate you very much. Have a blessed and victorious week, for this is the week God has ordained for you.